Money market funds are designed to be a safe place to temporarily park your savings while retaining immediate access and generating a return which is slightly higher than cash. But there are some concerns that these funds could trigger what's called a cash crash. So in this video, I look at whether these funds are safe and what could go wrong. And the biggest risk is not what you might think. This video is sponsored by Trading 212, which is a UK commission-free investment platform. So let's look at whether money market funds are safe in a bit more detail. So what is a money market fund? Well, it invests in very safe things. So it's designed to be safe. It's also designed to be liquid so that you can take your money out at any time you like. And how does it create that safety? Well, it invests in very short-term securities, which is very important, as we'll see. Now, a lot of people are concerned at the moment that we could be seeing something of a bubble for money market funds, which is very odd for what should be a very safe investment. So if we look at the total amount of money invested in money market funds in the US, you can see how at the moment it's roughly $6 trillion. So this is an absolutely huge market. Furthermore, you can see how rapidly it's been growing recently. Also, it's dominated by certain big players in money markets. Fidelity's the biggest, JP Morgan's the second biggest, and Vanguard's third biggest, with Fidelity alone having over $1 trillion worth of assets parked in money market funds. Now in the US, there are three subtypes of money market fund. The first type, which is probably the safest, invests in government debt, in this case US Treasuries. There's also some agency debt that they invest in, but these all come with a very high credit rating and the backing of the US government. There are also tax-exempt money market funds which invest in municipal bonds. With these, you don't have to pay local income tax if you invest in municipal bonds or these municipal bond funds. So they can be very tax efficient. The third type, which has the highest risk and also the highest return, are called prime money market funds. And these invest in commercial paper, which is a form of short-term debt issued by companies to get funding. Now in the UK, we don't have these subtypes of money market fund, in particular because we don't have municipal bonds. Our funds tend to be a combination of commercial paper and short-term gilts. So now I'll look at two examples, one for the US and one for the UK, drilling into some funds in detail. But what you'll see is common to both is that the bonds tend to be very short-term government bonds. Now if you have a very short-term government bond, it's more cash-like, it has a lower return, but it also has much less volatility. The price fluctuates very little, as if it were an investment in cash. Now, of course, in the US, it'll be buying short-term T-bills, that's what they're called in the US. In the UK, they'll be buying short-term gilts. Now, to get slightly higher return, but also take a bit more risk, a bit of credit risk in fact, you can also buy commercial paper. Now these are usually issued by financials, financial companies. These could be regional banks, it might be an insurance company, but really it's a way of getting short-term funding, and the issuers, the companies which issue these bonds, tend to have a very high credit quality. In the US, there's another category which is repo. This is when the money market fund takes its cash, gives it to the Federal Reserve, and receives US Treasuries as collateral. So you can think of that as a very safe short-term loan to the Federal Reserve. And then finally, we have certificates of deposit. These are deposits with banks. Again, these generate return with very little interest rate risk. Now, for all of these instruments, because they're short-term, as yield curves move up and down, they don't affect the price of the fund. They affect the return of the fund, but not the price. So that's very important to understand that distinction. So looking at a US money market fund, this is the Vanguard Federal Money Market Fund, you can see how its composition looks. The largest category for this fund, which makes up 41% of the investments, is repo. So this is very safe, it's collateralized lending, and that's generating a pretty good return at the moment. The repo rate offered by the Fed as I make this video is over 5%. The second biggest category, which makes up about a third of the fund, is US government obligations. And then the final category, which makes up another third, is US Treasury bills, these very short-term US government bonds. Notice in this case there's no commercial paper at all, and that's because this is not a prime money market fund which would buy commercial paper. Looking at the equivalent fund here in the UK, this is the Vanguard Short-Term Money Market Fund. The composition is similar, although you'll notice there isn't any repo here. UK Treasury bills, which are very short-term government gilts, make up about 40% of the fund. A third of it is time deposits. These are deposits with banks. And commercial paper makes up about a fifth of the fund. So all very safe stuff and very short-term paper. This matures in a very short period of time. So how come such a boring investment has suddenly become so popular? Now, for commentators who are always saying that the world is ending, the reason given behind this flocking of money to money market funds is that people are terrified of a crash. However, I'd argue that the argument is much simpler. It's simply because money's flooding into these funds because interest rates are higher at the short end of the curve. So what you can see here is the amount of deposits with commercial banks. That's in the top panel, and that's been dropping recently. And the reason why is in the bottom panel, that's the federal funds rate, which is roughly what a money market fund will earn in the US. The equivalent here in the UK is called SONIA, the Sterling Overnight Index Average. But what you can see in the US very clearly is that as the short-term interest rate, the Fed funds rate, has increased, then so has the money flooding into money market funds. That's what you can see in the middle panel. And because the rate isn't as attractive at a bank, you can see money moving out of banks and into money market funds. So I think this is why they're popular. The Bank of England made a point recently, and this is in its November monetary policy report, that while banks have been very quick to increase mortgage rates for borrowers, they haven't been quite so quick to offer higher interest rates for instant access cash deposits with their bank. And the FCA's actually done an investigation into this and chastised UK banks for not passing on those higher rates. So what proportion of that higher short-term interest rate has been passed through to savers in their instant access cash accounts? The UK actually comes out top in terms of that pass-through. So the deposit beta for the UK is 43%. So we get about 40% of the increasing interest rates passed through to us in our deposits with our banks. In contrast, US banks have only given 25% of the rate increases to their customers. And the EU average is even more stingy at just 20%. Now, today's video is sponsored by Trading 212, which I've been using for some time as part of my fund portfolio. Now, that's not just because it's a low fee platform, although it is. So, for example, it was the first broker in Europe to offer fractional shares and commission-free trading. But it carries on innovating. For example, you can earn interest in multiple currencies. That can be sterling, dollars, or euro. And that's in the Invest account, but also the ISA account, which is offered by Trading 212. Furthermore, it's got a really powerful feature where you can create a portfolio within a portfolio, something called a pie. One of the real pains with DIY investing is that you have to rebalance your portfolio. But if you store that portfolio as a pie, you can do it with just one click. Furthermore, there's a social aspect to pies where you can look at other people's pies and use that as inspiration for your own investments, or you can copy their pie. Now, for viewers of PensionCraft, you can earn a share worth up to £100 by creating a new account on Trading 212, verifying it, depositing at least £1, and then using my name as a promo code. So that's my first name, Ramin, R-A-M-I-N. And you can learn more about that offer by looking at the description below. So now let's ask the question, are these funds actually safe? So what I've done here is to compare a popular UK money market fund, CSH2 from Lixor, against a Vanguard maintained fund called VWRP, which buys global stocks. Notice how CSH2 has almost zero volatility. It just gradually rises upwards as if it were a bank account. And in many ways, a money market fund is like a bank account. Whereas if you look at VWRP, you see huge fluctuations in the value of the fund. Also, the returns aren't that great since 2022 for global stocks. That's partly because sterling has been strengthening versus the dollar, and it's reduced the returns of US investments as a result. If we were to take a longer period of time, as we'll see, you'd actually see a much bigger return on stocks than you would with money market funds. So it's not that surprising that money market funds are safer than stock funds. Stocks are notoriously volatile. But how about a global bond fund? So what I'm doing in this graph is to compare that money market fund, the same one, CSH2, against a global bond fund. Furthermore, the bond fund is sterling hedged, so it's removed the currency fluctuations. So what's pretty clear here is that CSH2 has also outperformed global bonds because it doesn't take duration risk. Because it sticks to very short-term investments, you don't get these massive fluctuations in price, which you do get with a global bond fund. As yield curves have moved up globally, the price of this fund has dropped very sharply, in this case by 11%. Now, what we all know is that volatility is not the same thing as risk. You can have something which doesn't fluctuate much in price, but which could crash in some extreme market conditions. So that's what we're going to talk about now, tail risks. These are low probability events which have a big negative outcome on money market funds in particular, but for the entire financial system. Now, the scenario which I think is most likely is one in which interest rates start to fall. Why would that happen? Well, it would happen because central banks feel as if they've conquered inflation. The very high rates that we're seeing from the central banks, such as the Bank of England, the Federal Reserve, the European Central Bank, will eventually be put down to more normal levels, maybe 2–2.5%. And when that happens, money market funds will very quickly pick up those lower rates of interest and become less attractive. Probably at the same time, stock markets will rip upwards. So what's likely to happen in this scenario is that money is going to flood out of money market funds. Now, as the funds get redemption requests, people pulling their money out, the fund manager has to sell assets in order to pay them their cash. And they may not be able to sell the assets quickly enough. So a potential risk is that these money market funds get gated as money floods out of the fund. That means you can't pull your money out. However, there is something that mitigates this risk. Remember, if we look at one of these money market funds, and here I'm showing the UK short-term money market fund from Vanguard, the duration of the paper inside the fund is very short. So you can see the weighted average life of the investment is just 36 days. That means that a lot of the investments in this fund will mature, turn back into cash, within about 2 months. So I think that'll severely limit how long these funds could be gated. All you've got to do is hang around for a couple of months and you're very likely to get your money back. That's unless we get a much more severe outcome, and that's to do with the banking crisis. And it would have to be a really huge banking crisis because a lot of these issuers of commercial paper would have to default. In other words, the banks themselves would have to become bankrupt and the central banks would have to not step in to avoid those defaults. So in this really extreme banking crisis scenario, we'd have to see lots of these issuers defaulting, or maybe just one big issuer of commercial paper would default, as it did in 2008 with Lehman, and consequently the funds which have invested in that commercial paper would break the buck. They'd lose some chunk of their value, the amount which was invested in the bonds of that issuer, and that would cause a general panic. And as part of that panic, money would stampede out of money market funds because people would be worried about the next shoe to drop. Now, I'd argue the biggest shock in 2008 wasn't necessarily Lehman Brothers, it was the repercussions of Lehman Brothers which were triggered by the bankruptcy. And this is because the commercial paper market essentially froze up. Another consequence was that a really big money market fund, which had bought a lot of Lehman paper, was the Reserve Primary Fund, which broke the buck. And this was a really big fund, and people were terrified. So the two things that followed that breaking of the buck was that the commercial paper market essentially froze up. The amount invested in the commercial paper market fell by 95 billion over the course of just 1 week. And over the course of 3 weeks, 200 billion was taken out of that market. And of course, there was a stampede out of money market funds, the prime ones, which bought commercial paper. So this is the analogy that people are remembering when they're talking about a freezing up of commercial paper in a future crisis. However, I think it's always worthwhile looking at the scale of the losses that people suffered in that reserve primary fund. Now, it took a while, but by 2014, investors had retrieved all but 1% of their investment. So they recovered 99% of what they'd invested in the first place. So what looks like an absolute catastrophe in the money market fund space is just a fairly average day in the equity market. Furthermore, I think for there to be a banking crisis currently would take a very big change in the macroeconomic picture. Since 2008, what central banks have been very busy doing is ensuring that banks have much stronger balance sheets than they did before 2008. They ensure this by forcing banks to keep more safe capital on their books. This is loss absorbing capital, as measured by the CET1 ratio. But essentially the idea is that if the CET1 ratio is higher, that means the banks are safer. They've got more loss absorbing ability. So that's true for the UK, as you can see in this graph beside me, but it's also true for the US. Generally, banks are very well capitalized. So I think a default storm, which is what it would take to freeze up the commercial paper market, is just very unlikely. And what we're seeing at the moment is not a story of recession. In fact, almost every headline that we see about the economy is saying that things are resilient. Gilts recently sold off in November in 2023 as a result of headlines about the strength of the UK economy. The UK clothes retailer Next showed very strong guidance for its next set of earnings. And this is again due to consumer resilience. People are just going out and shopping, which again is surprising given the huge increase in the cost of living that we've seen recently. And of course, we see exactly the same pattern in the United States, where the consumer has simply not stopped spending. In fact, it's something of a retail boom that we're seeing. Now, this is not the kind of macroeconomic environment where you'd expect to see a banking crisis. The economy is pretty strong in developed markets, and if that's the case, banks are cyclical. They're unlikely to suffer in terms of profits. So what is the single biggest risk with a money market fund? I'd argue that the biggest risk is that you stick with it for too long. You can almost guarantee that these funds will underperform stocks over the long term. Here beside me, you can see the returns on stocks, on government bonds, and on short-term government bonds, the type that money market funds invest in, at the bottom. And these returns are for the period between 1900 and 2022. Now, there's a huge 6% underperformance of money market funds and T-bills compared to stocks. So if you stick with money market funds and you stay cautious, you're almost guaranteed to underperform long term. So I'd say the biggest risk is that you keep your money in a money market fund, you're too cautious long term, and you underperform. The risk is that you love money market funds a little bit too much. So to answer my original question, yes, I think money market funds are still safe. It's very difficult to imagine a world in which we go back to the 2008 scenario where the commercial paper market freezes up due to huge bank failures. At the moment, what we see is economic resilience rather than economic crisis. And in that kind of scenario, I think money market funds will remain safe. Now, don't forget the offer from Trading 212. You can claim a free share worth up to £100. To do that, you just open a new account, verify it, deposit at least £1, and use a promo code, which is my name, RAMIN. And, as always, thank you for listening.